$1.3 trillion in a single quarter. That's not a healthy market, Nate. It's panic.
Panic? Unilever dropping $44.8 billion to merge with McCormick is strategic genius. They're cornering the global spice rack.
They're buying pantry staples because software valuations are quietly imploding. Buyers are terrified of AI disruption and demanding massive discounts.
A classic tale of two cities, but you can't deny the sheer momentum here.
Watch me. Let's look at the actual footnotes on this spice mega merger. The rundown.
I just want to know if the Danone board actually sat around a mahogany table and drank Huel before signing the term sheet.
They just paid $1 billion for liquid meals. I'm guessing they chugged it.
It's a genius move. Danone is bulking up its nutrition portfolio, and tech bros need their optimized protein sludge.
Danone saw their yogurt margins flattening and panicked. But fine, $1 billion buys you the Silicon Valley meal replacement crown.
Speaking of Silicon Valley, Ecolab is dropping $4.75 billion on CoolIT Systems.
This is the deal that actually made me do a double take. Ecolab is commercial cleaning. They do hotel laundry and water treatment. Now they're suddenly dropping nearly $5 billion to cool AI data centers.
It makes total sense. AI servers run incredibly hot. You need liquid cooling. Ecolab knows fluid dynamics and water management better than anyone. It's a brilliant expansion.
Oh, come on. $4.75 billion is an insane premium for server cooling hardware. I read the footnotes on their investor deck, and the projected synergies look entirely fabricated.
You're just allergic to a good narrative. CoolIT has the proprietary tech. Ecolab has the global enterprise relationships. They're going to print money.
I'll buy the narrative when the cash flow actually shows up in a 10Q. Right now, it just looks like they paid a massive tax to slap AI infrastructure on their earnings call.
Look, you have to pay the AI tax right now. Morgan Stanley's M&A desk is calling it a tale of two cities. If you have hardware or power or cooling, you write your own check. If you sell traditional software,
Your valuation is taking a beating.
exactly. Buyers are spooked. They're demanding 20-30% discounts behind closed doors because they think an AI agent is going to make your SaaS product obsolete in 2 years.
Which is why the smart money is sticking to the classics. Gilead just quietly spent $2.2 billion on Ouro Medicines to expand their autoimmune pipeline. No AI hype, just clinical data.
Traditional, steady, boring?
I wouldn't call this quarter boring, Nate. We just hit $1.3 trillion in global deal volume. Trillion with a T.
A record-breaking quarter. And we all know exactly which $44.8 billion deal pushed us over the edge.
The spice must flow.
It really must. We need to look at how Unilever managed to swallow McCormick and why the entire food and beverage sector is totally freaking out. The big one. $1.3 trillion in 3 months. I had to read that terminal alert twice just to make sure I wasn't missing a decimal.
It's a staggering number for a first quarter, and nothing says the animal spirits are back quite like a $44.8 billion grocery cart.
Unilever and McCormick, the mayonnaise people joining forces with the garlic powder people, it's a massive swing to create a global food powerhouse.
It's huge, but look at the fine print. Did you catch the expected close date?
Mid-2027.
Mid-2027. That's 3 years of antitrust purgatory. You don't put a 3-year timeline in your press release unless your lawyers have already warned you that regulators are going to make your life a living hell. We're going to see so much competitor pushback on this.
Okay, sure, the regulatory path is going to be a marathon through a minefield. But strategically, I love this deal. I really do. It's a brilliant margin play. You get unprecedented pricing power on the middle shelves of every supermarket on Earth.
Oh, come on. Brilliant? They're buying growth because they forgot how to invent it. Unilever's food volume has been flat. They're just slapping their distribution network onto McCormick's spices and trying to convince Wall Street it's a superpower.
Spoken like a true cynic.
I'm looking at the price tag. You know, I hate a defensive mega merger disguised as a strategic masterstroke. They're paying an unbelievable premium.
It's not disguised as anything. It's scale. Pure, unapologetic scale. Listen to me. I sound like I'm back in a midtown boardroom trying to justify a pitch deck.
You really do. I was waiting for you to say the word synergy and then ask for a bonus.
I held back, barely. But seriously, this deal perfectly illustrates the Morgan Stanley note from this morning. Their global co-head of M&A called the current market a tale of two cities.
Right. You have these legacy industries doing massive premium-heavy consolidation, but the gossip behind closed doors, software valuations are quietly taking an absolute beating.
It's wild. Buyers are spooked by AI disruption, and they're demanding massive discounts on software targets.
Because nobody knows what a SaaS company is worth if an AI agent can write the same code in 10 seconds. The food giants are paying a premium for black pepper, while tech buyers are treating software companies like distressed assets.
Because black pepper can't be replaced by ChatGPT?
Not yet, anyway.
Give Silicon Valley a week. But speaking of things AI actually needs to survive, we should probably talk about the sheer amount of equipment required to keep those data centers from melting down.
You mean Ecolab dropping $4.75 billion on liquid cooling?
Exactly. That's a completely different kind of tech play. Voices. Morgan Stanley's global co-head of M&A used my absolute favorite cliche this week. He called the AI deal landscape a tale of two cities.
It was the best of times. It was the worst of times for pitch decks.
Exactly, but the gossip I'm hearing backs him up completely. Behind closed doors, legacy software valuations are getting absolutely hammered. Buyers are demanding massive discounts because they're terrified AI is going to make these platforms obsolete in 18 months.
I'm pushing back on that narrative right now. Blaming AI is just a convenient excuse for buyers who finally woke up to reality. Those software valuations were completely divorced from gravity for years.
You don't think AI is fundamentally breaking the SaaS model? Oh, come on.
I think if you're paying 20 times revenue for a glorified workflow tool, you deserve to get burned. The AI disruption story is just air cover for private equity to lowball their offers. They read one headline about ChatGPT and suddenly want 40% off the asking price. Show me the actual churn numbers, then we can talk about obsolescence.
Spoken like a true data purist, but the fear is real on the sell side. Meanwhile, Deloitte is singing a very different tune over in the financial sector. They just put out a note calling 2026 a throttle up moment for banking M&A.
Throttle up. Who writes this stuff?
Hey, bankers love Top Gun. I used to quote Maverick in my slide decks, but Deloitte is arguing the regulatory logjam is finally clearing. Deal conversations are accelerating and approval timelines are shrinking.
I'll believe the shrinking approval timelines when I actually see them in a quarterly filing. Regulators aren't exactly waving mega mergers through the fast lane right now. They're scrutinizing everything.
Which brings up a very interesting question about what happens tomorrow. Because after that $44.8 billion Unilever and McCormick shocker, you know the antitrust lawyers are already sharpening their knives. Spill the tea.
I'm looking at these private software term sheets, and it's just a bloodbath. Everyone is talking about the mega deals, but behind closed doors, buyers are demanding 30, sometimes 40% discounts.
It's total panic. Morgan Stanley's M&A co-head literally called it a tale of two cities this morning. If you have an AI angle, you get a blank check. If you're a traditional SaaS company, buyers look at you like you're a horse and buggy.
Because they kind of are. If your entire moat is a workflow tool that an AI agent can build in a weekend, why would a buyer pay 10 times revenue for that? The discount is completely justified.
Oh, come on, you're buying the customer base, the switching costs, the enterprise contracts. An AI agent doesn't just magically bypass a corporate procurement department. Buyers are just using AI disruption as an excuse to lowball. It's classic banker opportunism.
Spoken like a true former banker, you know exactly what they're doing.
Hey, I respect the hustle. Speaking of hustle, Harbor IT is throwing elbows right now. They're aggressively hunting managed service providers, specifically anyone doing over 10 million in recurring revenue.
It's causing a massive bidding war in the compliance and cyber sectors. 10 million in ARR is suddenly the magic number.
It's the new 6-foot height filter on dating apps for private equity. If you're at 9.9 million, swipe left. But if you hit 10, you've got 3 term sheets by Friday.
Very accurate and very expensive for Harbor.
We'll see if it pays off. But speaking of things paying off, keep your eyes on the NASDAQ tomorrow morning. RIVL and RTB Digital are finally trading under the new RTB ticker.
Right. And we're definitely going to be watching the grocery aisle to see if regulators or competitors try to blow up that Unilever and McCormick monster deal. Ihan, tomorrow's radar.
Keep an eye on the NASDAQ tomorrow morning. Rival and RTB Digital are finally trading under the new RTB ticker.
I'm way more focused on the Unilever McCormick fallout. You know, antitrust regulators are already drafting objections. Mid-2027 close? Please. That timeline is a complete fantasy.
Oh, come on, it's spices and mayonnaise. The FTC has bigger fish to fry.
Have you looked at grocery inflation lately? They absolutely care about mayonnaise. But fine, if you want real drama, look at software valuations. Buyers are demanding massive discounts behind closed doors.
Because everyone is terrified of AI disruption. Morgan Stanley called it a tale of two cities, but for legacy SaaS, it's just a bloodbath. Though Harbor IT completely missed that memo. They're aggressively hunting managed service providers.
Only the ones with over 10 million in recurring revenue. They're single-handedly sparking a bidding war in compliance in cyber.
So do they overpay or are they timing the bottom perfectly?
My money is always on the banker making them overpay. We'll pull the filings tomorrow and find out.